In this breakdown, we'll unpack the key drivers powering Costco's long-term compounding engine, how a low-margin, no-frills model turns scale and loyalty into outsized returns. This is Costco, the wholesale retail giant. Let's dive in. At the heart of Costco's success is a deceptively simple engine. First, there's loyalty economics. Members pay to shop and then keep coming back year after year because they genuinely save money. That recurring revenue creates predictability most retailers only dream of. Second, relentless value through scale. Costco operates on razor-thin markups, but its massive purchasing power means it can still make money and pass most of the savings on to customers. And third, a long runway for expansion. The model works globally, and Costco is only scratching the surface outside North America. Together, these forces power something rare in retail: a durable, compounding growth story with real staying power. So what does Costco actually do? Members pay an annual fee just for the right to shop. That might sound strange, but the value is clear. The prices are consistently lower than anywhere else. Costco sells in bulk, keeping costs down and inventory moving fast. Because it buys so much, it gets rock-bottom prices from suppliers and passes those savings straight to members. This creates a powerful recurring revenue engine. With renewal rates around 93%, members stick around, generating predictable income with minimal churn. And then there's Kirkland's Signature, Costco's private label. It now makes up over a quarter of sales and has become a trusted brand in its own right. That deepens loyalty and helps margins. It's a model built on trust, discipline, and repeat behavior, which makes it a perfect foundation for compounding. Costco's compounding isn't luck. It's built on structural advantages that are hard to replicate. Start with pricing. Most retailers add a hefty markup to make their profits. Costco doesn't. It keeps product markups around 12%, often less, and instead makes its money through membership fees. That makes it almost impossible for others to compete on price. Then there's loyalty. With 93% of members renewing year after year, Costco has one of the stickiest customer bases in retail. That kind of recurring revenue makes the business more predictable and more valuable. And finally, fast inventory turnover. Costco carries far fewer products than a traditional supermarket, but sells a ton of each one. That tight focus keeps inventory moving fast, boosting efficiency, asset turns, and returns on invested capital. These three levers, price, loyalty, and turnover, work together to drive durable, long-term compounding. Costco's entire business model hinges on one thing: delivering way more value than it takes in. A standard membership costs $60 a year, but the average member saves around $750, mostly on essentials like groceries, fuel, and personal care. That's a 12.5 times return. It's a virtuous cycle. The more you shop at Costco, the more valuable your membership becomes. It's a loop that reinforces itself. Because once people experience those savings, they don't want to shop anywhere else. This is why renewal rates are so high. It's not just about loyalty, it's simple economics. A Costco membership pays for itself many times over. That 12.5x value proposition is why renewal rates hover around 93%. It creates a loyal, recurring revenue base, which helps explain how Costco's growth has been so steady, even through different economic cycles. This chart reinforces what we've just seen. Costco's compelling 12.5x value proposition and 93% member retention drive a powerful recurring revenue stream. Over the past 15 years, that's translated into an impressive 8.4% compound annual revenue growth, delivered consistently, even through varying economic cycles. For us, that kind of stability and visibility is a key indicator of quality. Costco now operates around 900 warehouses, and it's still adding 20 to 30 more each year. That expansion, both in the US and abroad, is fueling meaningful growth. Over the past 5 years, membership fees and operating profit are both up more than 80%. The model travels well, and with plenty of white space internationally, Costco's compounding story still has a long runway ahead. Unlike most retailers, Costco's margins are low by design. Its model is built around buying in bulk, keeping markup to just around 12%, and passing those savings on to members. The result? Loyal customers and efficient turnover, not margin expansion. It's a deliberate trade-off: volume over markup and trust over short-term gain. And this margin discipline has remained consistent through cycles. This is a favourite metric of ours, because return on invested capital shows how efficiently a business turns growth into real value. Costco's return on invested capital has climbed steadily, now well above 30%. That tells us the business is scaling efficiently. It's not just growing, it's getting better as it grows. Sustained high ROIC like this is a hallmark of a quality compounder. Here the blue bars show net debt to EBITDA, and the red line highlights the percent of net income converted to cash. Costco runs with virtually no net debt and consistently converts earnings into cash. Free cash flow has averaged over 100% of net income, which speaks to the quality of the earnings and the efficiency of the model. It's a rock-solid balance sheet, built to weather any cycle. No business is risk-free, even one as consistent as Costco. The key things to watch are renewal rates, which power the whole engine, deflation in key categories like fuel and groceries, which could dilute the perceived value of membership, and of course competitive pressure, especially from low-cost online players. These aren't deal breakers, but they're worth monitoring. If you're tracking Costco over time, these are the 3 metrics to watch. Organic revenue growth, steady in the mid to high single digits. Gross margins at around 12% by design. And most importantly, membership renewal rates, ideally holding around 93%. Together they tell you if the engine is still running as it should. Costco scores 8.2 out of 10 in our quality framework, firmly in high-quality territory. Its standout strengths: competitive advantage, driven by unbeatable prices, trusted private label products, and exceptional loyalty. And financial strength, with negative net debt, high free cash flow conversion, and a rock-solid balance sheet. It's a business that's built for consistency and built to compound. Costco is a masterclass in scale economics, customer loyalty, and operational discipline. Its value proposition is simple, but hard to replicate. And that simplicity, executed at scale, creates powerful barriers to entry. With strong moats, high returns, and a pristine balance sheet, this is what a high-quality compounder looks like. If you'd like to dive deeper, you can download the full one-pager at compounding-academy.com. It brings everything together, from financial metrics to competitive positioning, in a single snapshot. It also includes our quality score, which reflects our proprietary framework for assessing long-term compounders. And while we don't include valuation in these slides, to keep them timeless, we do update our valuation views regularly, and that's something we reserve for paid subscribers. Alright, that wraps up our breakdown on Costco. If you're enjoying these focused takes on high-quality businesses, subscribe to stay in the loop. We're building a full library of breakdowns like this, designed to help long-term investors spot the real compounders. And while Costco scores highly across the board on quality, keep in mind, valuation always matters. Even great companies can be poor investments at the wrong price, so we'll be covering that angle too in future pieces. If this was helpful, feel free to share it, and check out compounding-academy.com for more deep dives, one-pagers, and tools to help you make smarter investment decisions.